Yo, what's good? Financially illiterate legends. Welcome back to another episode of Holy Shit, That's Not How Money Works. Today, we're tackling something that's going to blow your mind and probably make you realize you've been measuring your financial success completely wrong this entire time. We're breaking down the difference between income, cash flow, net worth, and what the hell financial freedom actually means. Because, spoiler alert, making six figures doesn't mean you're rich, and being rich doesn't mean you're financially free. I know. Your brain is already short-circuiting. But my salary? But my net worth? But the finance influencer with the Rolex said, shut up, sit down. Let me educate you before you waste another decade confusing these concepts and wondering why you're still stressed about money, despite doing well. Let's fucking go. Here's a reality check that's going to sting. I know people making $300,000 a year who are broke. I also know people with a $50,000 salary who are financially free. How is that possible? Because they understand something you probably don't. Income is not wealth. Cash flow is not income. Net worth is not cash flow. And none of these automatically equal financial freedom. These are four completely different metrics, and if you're optimizing for the wrong one, you're basically trying to win a swimming race by running really fast. You're trying, you're sweating, but you're in the wrong fucking pool. By the end of this video, you'll understand exactly what each of these means, why they matter, and which one you should actually be obsessing over. Prepare to have your worldview shattered. Let's start with income because this is the one everyone brags about. I make six figures. Cool story, bro. What's your take-home after taxes, insurance, and retirement? I don't know. Exactly. Income is how much money you earn before anyone takes their cut. It's your salary, your bonuses, your side hustle revenue, your freelance fees, all the money coming in the door. Here's the problem. Most people think high income equals financial success. They see that big number on their offer letter and think they've made it. Then they wonder why they're still living paycheck to paycheck despite pulling in $150,000. Let me explain why income is the most overrated financial metric in existence. First, income is temporary and fragile as hell. It requires you to keep showing up and performing. Miss work? No income. Get fired? No income. Get sick? No income. Your income is basically held hostage by your ability to trade time for money, and the second you stop trading, the money stops coming. Second, high income comes with high taxes. The more you make, the more Uncle Sam takes. You make $200,000? Congratulations, you're in the 32% federal tax bracket, plus state taxes, plus Social Security and Medicare. You're giving away 40 to 45% before you even see it. So that $200,000, it's really $110,000 to $120,000 hitting your account. Still good money, but it's not what you thought you were making when you signed that contract. Third, and this is the kicker, high income enables lifestyle inflation faster than a Ferrari on an open highway. You get a raise and what do? Upgrade your apartment, lease a nicer car, eat at fancier restaurants. Start shopping at Whole Foods instead of Trader Joe's like you're some kind of aristocrat, because your arugula is now organic. Before you know it, your $150,000 lifestyle costs $148,000 to maintain, and you've got $2,000 left at the end of the year. You're making good money, but you're broke. You're a high-income poor person. This is why professional athletes go bankrupt. This is why celebrities file for bankruptcy. This is why people making $500,000 a year are stressed about money. Income without financial intelligence is just a bigger shovel to dig yourself a deeper hole. Now let's talk about cash flow, which is what actually matters in your day-to-day life, but nobody pays attention to. Cash flow is simple. Money in minus money out. That's it. Positive cash flow means more money is coming in than going out. You're in the green, baby. Negative cash flow means you're bleeding money every month, and you're either going into debt or draining savings to stay afloat. Here's the wild part. You can have high income and negative cash flow. How? Because you're spending more than you make, you absolute genius. But I make $10,000 a month. Yeah, and you're spending $11,000. Congratulations. You're drowning in designer clothes. Cash flow is the lifeblood of your financial health. It doesn't matter how much you make if it's all going out the door faster than it comes in. This is why cash flow is actually more important than income for most people. You can survive on a modest income with positive cash flow. You cannot survive on a huge income with negative cash flow. One is sustainable, the other is a ticking time bomb. Let me give you an example. Person A makes $60,000 a year and spends $45,000. They have $15,000 positive annual cash flow. Person B makes $200,000 a year and spends $210,000. They have negative $10,000 annual cash flow. Who's in a better position? Obviously, person A. They're building a gap, they're saving, they're investing, they're getting ahead. Person B is making more than 3 times as much and going backwards. They're accumulating debt or draining savings. They're one job loss away from catastrophe. But society looks at person B and says, wow, you're so successful, while person A gets, when are you going to get a real job? This is the mindfuck of modern finance culture. We worship income and ignore cash flow, which is like judging a business by its revenue instead of its profit. It's missing the entire point. Here's the brutal truth. Positive cash flow is what allows you to build wealth. You can't invest money you don't have. You can't save money that's already spent. The gap between what you earn and what you spend is where all financial progress happens. No gap, no progress. It's that simple. All right, now we're getting to net worth, which is the metric that actually measures wealth, but everyone calculates it wrong. Net worth is simple math. Assets minus liabilities. Everything you own minus everything you owe. Your house, your car, your investment accounts, your savings, that's assets. Your mortgage, student loans, credit card debt, that personal loan you took out to buy a jet ski you used twice, that's liabilities. Add up all your assets, subtract all your liabilities, and boom, net worth. Here's where people fuck this up spectacularly. Mistake number 1. They count depreciating assets at full value. My car is worth $40,000. No, it's not. Your car is worth whatever someone would actually pay for it today, which is probably $28,000 because you drove it off the lot and it immediately lost value like it was cursed. Mistake number 2. They don't count liabilities correctly. I have a $500,000 house, so my net worth is $500,000. Really? What about your $450,000 mortgage, genius? Your net worth from that house is $50,000, not $500,000. Mistake number 3. They think high net worth means they're financially secure. You can have a $2 million net worth and be broke if it's all locked up in liquid assets. Let me explain this one because it's important. Imagine your net worth is $1.5 million. Sounds great, right? You're a millionaire. Except $1.2 million is your home equity. $200,000 is in a retirement account. You can't touch for 20 years, and $100,000 is in your kid's 529 college fund. You have $1.5 million net worth and exactly $0 available to pay your bills. This is why you can be rich on paper and still stressed about money. Net worth doesn't equal liquidity. It doesn't equal cash flow. It's just a scorecard that tells you if you're accumulating wealth over time. Net worth is important for tracking long-term progress, but it won't pay your mortgage this month. It won't buy groceries. It won't cover an emergency. Here's the proper way to think about net worth. It's a snapshot of your financial health at a single point in time. It should be growing year over year. If it's not, you're doing something wrong. But obsessing over net worth while ignoring cash flow is like obsessing over your weight while ignoring your diet. The number is a result, not the cause. You don't build net worth directly. You build it indirectly by having positive cash flow, investing consistently, and not doing stupid shit like buying liabilities disguised as assets. Which brings me to the most important distinction nobody talks about. An asset is something that puts money in your pocket. A liability is something that takes money out. Sounds simple, right? Yet somehow everyone gets this backwards. Your primary residence is not an asset. I know. Your real estate agent told you it is. Your mortgage broker told you it is. Everyone told you buying a house is building equity and investing in an asset. They're wrong, or they're lying to make a commission. Probably both. Your house costs you money every month. Mortgage, property taxes, insurance, maintenance, HOA fees, money is flowing out of your pocket. That's a liability. It might appreciate over time, but while you're living in it, it's costing you money. Now, a rental property you own, that's an asset. Why? Because it generates positive cash flow. Someone else pays you rent, which covers the mortgage and expenses, and you pocket the difference. Money flows in. Same with your car. It's not an asset. It's a depreciating liability that costs you money in payments, insurance, gas, and maintenance. Every month, money flows out. But here's where people's brains break. They have a $300,000 house with a $250,000 mortgage, a $40,000 car with a $35,000 loan, and they think they have $90,000 in assets. No, dummy. You have $90,000 in equity. Sure, but these aren't producing cash flow. They're costing you cash flow. You're confusing ownership with assets. Real assets are things like investment accounts that grow and generate dividends, rental properties with positive cash flow, businesses that generate profit, royalties from intellectual property, anything that puts money in your pocket without you having to work for it. That's wealth. That's what rich people accumulate, not cars and houses they live in. All right, now let's talk about what this all builds toward: financial freedom. Most people think financial freedom means having a lot of money. Wrong. Financial freedom means your passive income exceeds your expenses. Period. You could have $10 million in the bank and not be financially free if you're still working because you need the income. You could have $500,000 in dividend-paying investments and be financially free if it covers your lifestyle. Financial freedom is not an amount. It's a relationship between your passive income and your expenses. Let me break this down with numbers because apparently some of you need everything spelled out. Example A, you have $3 million invested generating 4% annually. That's $120,000 a year in passive income. Your lifestyle costs $80,000 a year. You are financially free. You never have to work again. Your money makes more than you spend. Example B, you make $500,000 a year at your job. You have $200,000 in savings. Your lifestyle costs $400,000 a year. You are not financially free. You're a slave to your job. Miss one paycheck and you're fucked. See the difference? Financial freedom isn't about the total amount. It's about the ratio. This is why frugal people can achieve financial freedom faster than high earners. If your expenses are $30,000 a year, you only need $750,000 invested at 4% to be free. If your expenses are $200,000 a year, you need $5 million. Most people are trying to increase their income to match their growing expenses. That's not financial freedom. That's a treadmill that goes faster the harder you run. Financial freedom is achieved by doing two things simultaneously: increasing passive income through investments, controlling or reducing expenses. You need both. Just controlling expenses makes you frugal but not free. Just increasing passive income while increasing expenses makes you rich but not free. Okay, let's bring this all together because your brain is probably melting. Here's how these four metrics work together to create actual wealth. Step 1. You need income to have money to work with. This is the raw material. Higher income is better, all else being equal, because it gives you more to work with. Step 2. You control expenses to create positive cash flow. This is the gap. This is where wealth is born. No gap equals no wealth building. Ever. Step 3. You invest your positive cash flow into assets that increase your net worth and generate passive income. This is where you're transforming cash flow into long-term wealth. Step 4. You repeat this until your passive income exceeds your expenses, achieving financial freedom. Now you work because you want to, not because you have to. This is the cycle. This is the path. There is no other way. You can't skip steps. You can't shortcut it. You can't hack it with some crypto pump and dump or MLM scheme. Income to positive cash flow to asset accumulation to financial freedom. Every financially successful person follows this path, whether they realize it or not. Every broke person is stuck somewhere in the cycle, usually at step 2 because they can't control their damn spending. Here's the hierarchy of what actually matters. Priority 1, positive cash flow. This is non-negotiable. Without this, nothing else is possible. Cut your expenses, increase your income, or both. But get this number positive. Priority 2, invest the cash flow into income-producing assets. Not your primary residence, not a car, not shit that makes you look rich. Real assets that generate returns. Priority 3, grow your net worth by consistently investing and avoiding stupid debt. Track it annually. It should be climbing every year. Priority 4, build toward financial freedom by increasing passive income while controlling lifestyle inflation. The finish line is when passive income is greater than expenses. Most people do this backwards. They obsess over income, inflate their lifestyle, buy liabilities, and wonder why they're not getting ahead. Let me hit you with some tough love. If you're making good money but still stressed about bills, you have a cash flow problem, not an income problem. If you have high net worth but no liquidity, you're rich on paper but poor in practice. If your income is your only source of money, you're not wealthy. You're employed. If your passive income doesn't cover your expenses, You're not financially free. You're financially dependent on your job. These are hard truths, but understanding them is the difference between looking rich and being wealthy. Look, I get it. This is a lot. And it's probably making you realize you've been optimizing for the wrong shit this whole time. You've been chasing a higher salary when you should have been building cash flow. You've been buying liabilities when you should have been accumulating assets. You've been trying to look successful when you should have been building actual wealth. But here's the good news. Now you know. Now you understand the difference. Income gets you started. Cash flow builds the foundation. Net worth tracks your progress. Financial freedom is the goal. Stop bragging about your salary. Start tracking your cash flow. Stop buying shit to impress people. Start buying assets that generate passive income. Stop confusing activity with progress. Start measuring what actually matters. The path is clear. The system works. You just have to actually follow it instead of whatever bullshit the Instagram finance bros are selling this week. Now get out there and build some actual wealth, you beautiful degenerates. If this video made you realize you've been doing everything wrong, hit that like button and subscribe so I can continue educating your financially illiterate ass. Drop a comment telling me which metric you've been obsessing over and ignoring the others. I'll judge you, then help you fix it.